Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily syndication show. I am Whitney Sewell, the host, and today our guest is Ben Lapidus. Thanks for being on the show, Ben.
Thank you, Whitney. Thanks for having me.
Ben is the Director of Acquisitions and Finance for Spartan Investment Group, LLC. He brings a skill in asset management and financial analysis to launch and grow Spartan's portfolio business line. With over 36 successful deals under his belt prior to Spartan, Ben is also founder and host of National Best Ever Real Estate Investing Conference and managing partner of Indigo Ownerships, LLC. Ben, would you give us a little bit about your background, how you got into real estate, and then how you got into real estate syndication?
Yes, sir. So got into real estate when I was in college. My folks decided to retire to another state from New Jersey to Virginia, but they were not ready to move. So they bought a house 8 years before they were ready to take the move on. So instead they rented it out. First time doing it. I was getting my finance degree. I looked at it, said, guys, you're getting a 2.5% return on your investment, with my big boots and my straps on. And I felt really confident that I was really smart about that. And they said, well, if you think you can do it better, go ahead. So they had the capital. They were excited about their 2.5 investment. So they decided to repeat. 4 houses later, I had participated more and more, improving their returns on each subsequent one. Around that time, I sold my business. I had a study abroad company that was selling about $1.5 million of sales to travel to Costa Rica to learn about renewable energy. A year after college, I sold it, used that cash to buy a couple houses myself, joined a tech startup in New York that had a bunch of VPs that made a bunch of money about 6 months later when it IPO'd. And they heard about this kid buying some real estate in a B market down in Virginia and said, hey, could you do the same for me? And I was surreptitious and a little bit off-putting, like, oh, no. This is only for the people who have the stomach for it, right? And that just made them want it more. So bought a dozen more houses that way. And when I realized that there was something there, that I had a skill set in being able to find cash flowing deals that had good returns and communicate it with integrity to people who trusted me, who I wanted a lifetime relationship with, that I was able to bring a pool of capital together and place it in an asset that would perform. I realized that combination of things I was good at. So I formally syndicated my first apartment building in 2014 in Richmond, Virginia, 38 units. Did a couple of fourplexes after that, and kept buying some single family. 2 years ago, when I decided to relocate after getting married and having a kid to Denver, Colorado, joined up with a team of folks who have more of a development core competency, who are good at project management, but needed a bean counter like myself to underwrite and be able to buy cash flow. And so together, we are syndicating investments on a much larger scale with a little bit more opportunistic insight for folks who are looking for an even greater return than the value add cash flow I was doing by myself however many years ago in New York.
Wow. That's a lot. So you went, I want to break that down a little bit. So you were in college and you started a company abroad.
That's right.
Right. And so
Yes,
at
sir.
the same time, you're buying houses.
Not quite at the same time. So my folks were buying houses at the same time, and I was kind of on the side involved. So after their first one, they started sending the numbers to me. After the second one, I started communicating directly with the realtor. After the third one, I started communicating directly with the lender. By the time they'd gotten their fifth house, I had some money. We did our fifth house together, their fifth house together. And by the sixth house, I already had the team kind of all set up when I put my own money into it when I sold my company. But it was until after I sold my company that I really formally got into real estate.
Was that still while you were in college?
That was a year after I graduated.
Wow. And what was your degree?
Dual degree in finance and economics.
Okay.
Out of state school though, it's nothing too special.
Okay. So tell us about how, getting into that first syndication deal. So you had done a few single family homes. What was your, confidence like going into that 38 unit?
It was pretty high. So I didn't think that that was something I could do, but I found a mentor, mutual friend of ours, Joe Fairless, back in
Nice.
2013. It was
Highly recommended.
highly recommended. It was, for the folks who don't know, Joe got started doing Skillshare classes before he was doing a podcast. So that's how he kind of, I think, peppered in his exposure as an educator and as a consultant prior to doing the podcast and working with other folks. And so he had just bought his first apartment building, $6.7 million deal with $15,000 down, saw that Skillshare class, said, "That's possible?" ? Showed up, 5 other people were there. He gave us 3 hours of his time in person. He was living in New York City too at the time. And he mentioned something that he was considering maybe doing this consulting program. And I raised my hand and said, yeah, I'll be the guinea pig for that. And so together, we bought that first syndication deal.
Nice. Very nice. So you had some confidence. Obviously a mentor like Joe helped you, give you confidence, right?
Yep.
And, normally I would ask, like, how did you pick your mentor? But you already knew him. You felt comfortable with him. You didn't have to do much selection, I guess, right? I mean, you knew who you wanted him to be.
Yes and no. I mean, that was the first time I'd met Joe, was at that Skillshare class.
Oh, okay.
And then we met up at a juice bar a couple of weeks later for a conversation. And then we only really touched base in person a couple more times after that before he moved to Cincinnati. But I think folks who are looking for mentors want to make sure that they're working with someone who has high integrity, who they can trust to have their back, who actually believes in the value of their services, isn't someone that is doing it for a 6-month period for a $40,000 or $120,000 fee as part of a schooling program that's a burn and churn, which, there's a lot out there like those. And I think everyone who knows Joe, he stands out from that.
Sure,
and
sure.
And I think a lot of us in the space who are looking to offer assistance are looking to position themselves the same way.
What was your duties in this first deal? What was your role making this happen?
My duties in this first deal was soup to nuts. I did everything, no partners. Did have Joe to call on, but I was the acquisitions guy. I was the investor guy. I was the operations guy. I was the lending guy, the personal guarantor. Everything.
What was more difficult, or what was the most difficult thing? Finding capital, raising capital, networking, asset management?
Well, at the time, I think late 2013, early 2014, deals were definitely not as hard as they are today. Capital was a little bit tougher. Imagine being a 23-year-old kid, calling on friends and family, calling on some other folks who tried this single family, but aren't really so sure about this multifamily thing. So that was newer. So I'm going to say that was newer, was raising the capital. But the operations of something like that was more difficult than I anticipated. I am not the best project manager. I'm not the best vendor manager, let's say. And I think I tend to have more trust and leeway for mistakes than I should. And so I've since found partners who are better at that than I am. I like to put the deal together. I like to underwrite it. I like to negotiate it. I like to find it. And I like to ensure a great financial outcome. The operational outcome was something that was more difficult for me.
We'll come back to the operation, but how about the capital raising? It being your first deal, I guess a lot of the listeners are going to be raising capital for their first deal, or they're getting that mindset of raising capital and talking to investors. Can you speak to them? Just give some pointers on that conversation and how they should begin that process.
Well, look, I think the biggest thing that I had in my head going on was my youth is going to hold me back, but I think the exact opposite was true. I think there's something to be said for being youthful, and interacting with other people who see something in yourself or see something exciting about you, who see a very long runway for you to perform and execute on their behalf. When you're in your early 20s, you might think, hey, I don't have any experience here, but that's not how everyone is going to perceive you. They're going to look at your character traits. They're going to look at your integrity, and they're going to look at how you talk about your worst case situation. And if things go bad, so be it. That's fine. You'll learn. But they know that you've got another 40 years ahead of you to help that make them money. They're investing as you in a person more than they're investing in your first investment. Because if it is your first investment and you are young, you will make mistakes. Certainly, it doesn't matter how much theoretical education you have. The actual application of it will be completely different than the theory. All plans are dead on arrival, right? So just know that they're investing in you. And I think that was something that I had to come to terms with, and come to terms with is the wrong phrase, recognize along the way that I was selling myself much more than I was selling the deal in that first round.
I like that. You're talking about selling yourself more than the deal.
Yeah.
And how did you educate yourself as far as an apartment complex? I know you had a great mentor, but what were you doing to, I guess, just to be ready for those questions that, everybody's so fearful of when they first get started?
So I think the very first thing that you have to be comfortable with is saying, I don't know. That's a great question. I don't know the answer to that. I hadn't considered that. But now that you've asked me that, I want to know the answer and I want to get you the answer. And I'm going to look into it and get back to you. And I appreciate you asking the hard questions versus getting potentially defensive or making something up. I think you have to be prepared to say, I don't know. And that's okay. In fact, there's a lot of power in that to say, I don't know, and to feel comfortable in that. So that's number one. But to actually get that information, you're going to learn a lot of it on the fly. I think if you have a good mentor, you've read some books, you've done some investing yourself, you've positioned your capital yourself, a lot of the questions that you receive from people investing their money are much less technical questions about the asset or about your underwriting. They're much more, how will I get my money back? The mechanics of the psychology that they're experiencing about investing the money and then getting it back. And so if you've invested before, having personal experience, either putting money with a syndicator or putting your own money at risk, I think that's the 80% solution, even if you don't have any of the answers, the technical answers, which you should. I mean, the basic underwriting classes are out there. I mean, the online classes are out there. You don't even really need to pay someone to teach you. You can learn quite a bit through Google and reading a few books. But I think the 80% solution is having your money at risk yourself, because then you understand the psychology of an investor and you'll be able to answer the majority of questions.
I like that answer a lot. Selling yourself instead of the deal, and just the fact that the investors are not going to be as savvy about the deal and things like that as you are, and not to be so worried about their questions, but just be ready to learn as you go.
That's right.
I know everybody I talk to teaches me something usually. So let's get into the operations a little bit. Maybe things that, you were educated, you had done numerous single family homes, but what are some things that were unexpected as you got into this deal?
So, I made definitely a few mistakes in my underwriting. The first thing that I made a mistake on was trusting the opinion of people who were incentivized for me to purchase the property. The real estate broker is incentivized, the property manager is incentivized, the general contractor is incentivized. If I purchase and I execute the business plan that I put forth, they'll all make money regardless of how the asset performs. The property manager makes money on revenue. The broker makes money when she sells it, regardless of what happens after that. And the general contractor makes money on the repairs that you've planned, regardless of your performance. So when everyone tells you, oh yeah, the rents are certainly going to be $700 a unit, that's market rate. And you are using that as your foundation to underwrite. You could be the best underwriter in the world with the best spreadsheets and the best if-then calculations, whatever, with this very sophisticated, very detailed plan. But precision does not equal accuracy. Your due diligence dictates that you have to go out and trust but verify that information. And I don't think I did enough of that. So I over-assumed what my rent potential was. And yes, I could get $700 a unit, but that meant that I was going to have units that were vacant, that were going to have to be turned, that were going to have a lot more capital out there. I couldn't just push it from $350 a unit to $700 a unit with the same tenant within 1 month. So I was not prepared to boil the frog, as you say, to slowly improve the property and slowly improve the rents. I assumed this would all be done in 12 to 18 months, which was not the case. I think the second challenge I had was the deferred maintenance was correctly estimated, but the amount of working capital I gave myself was not correctly estimated. I had some trouble finding a lender because I was an out-of-town investor and because the portfolio of assets being sold were non-contiguous. Non-contiguous means that the parcels were not located next to each other, that they were, let's say, a mile away from each other, two different locations. As a result, this $1.5 million property was really two $750,000 locations, which became too small for an institutional lender. So while I had targeted $1.5 million deal that looked good on paper because of my faulty underwriting, I really had an asset that required a regional lender, a local lender, but I was not a local guy, so I had difficulty getting a local loan. Consequently, I had to take out I had to have a $150,000 operating reserve. Someone finally said, yes, we'll give you a loan, but here's our requirements. And I had to compromise. But I had already raised money with preferred returns. I'd already closed it under the assumption of how much money I was going to raise. If I raised more, it was going to reduce the internal rate of return for the investors I already had there. And that was unacceptable to me. So I came up with some creative stuff. I got some seller financing that, 0% for a couple of years for my seller, took some more money out of pocket, 0% interest loan, kind of squeezed the numbers a little bit on working capital, was a little bit too optimistic, and as a result ran out of money. So ultimately, I didn't have the money that I needed to improve the property to get to rents that I couldn't have reached anyway. So those were my two mistakes. It wasn't a dead deal. I didn't lose the investor's return, but I realized very quickly that I was not going to be able to produce cash flow. And the psychology of sending a check is very important, no matter how small. And I couldn't do that. So I knew that I needed to exit this as quickly as possible. Luckily, it was 2014 when I purchased it. So appreciation was occurring regardless of how I had purchased the property. So I was able to exit the opportunity in a mediocrely positive manner for all of my investors after 3 years of operating it. I learned a lot, learned a ton, didn't really change my personal situation, but I did show some folks how I operate when things don't go according to plan. And I think that only improved the relationships for future investments.
Incredible. I'm sure it did. I hear many stories similar to that where people had to, go to investors and just be bluntly honest, and maybe the deal wasn't going as planned. And, but long term, I think almost every time that somebody has a story similar to that, they say the investor's confidence was greater in them, and most of them stuck with them long term.
More often than not, you're going to have the guy that says, hey, you promised me a 17% annualized return, but you had his money for 12 and a half months instead of 12 months. And he's knocking at your door for that other half a month of 17%.
Right.
So you've got guys like that, but usually if you're a person that is, full of integrity and you like having lifelong relationships, you're going to surround yourself with investors that are of the same mindset.
All right. So now let's fast forward to Spartan and what are your specialties for Spartan? What is your role in that company?
Yeah. So I drive both acquisitions and finance. I wear two hats, acting as the kind of the CFO, doing financial planning analysis for the company as a whole, as well as driving the acquisitions for all of our subsidiary LLCs, meaning every time we buy a new company, I'm given the yes or no, I'm doing the underwriting, I'm negotiating the price, I'm determining whether or not it's a go, and taking that information and rolling it up into our head company, Spartan Investment Group. My specialty is definitely on the number crunching, on the bean counting, on predicting the future for both our company as well as our subsidiary projects. But I'm also really picking up my marketing chops in being able to open up those conversations with potential acquisition targets.
I guess, give us some pointers on number crunching and maybe what, some specific things maybe you're looking at on a day-to-day basis that maybe we wouldn't normally be aware of.
Yeah. So I think the hardest part with acquisitions today is that it's impossible. Every deal is overpriced. Everything is really hard. That's not an excuse though. So instead of buying 1 out of 10 deals like we were in 2012, we're buying 1 out of 1,000. So, and you can't underwrite 1,000 deals. If your goal is to buy 10 properties in a year, you're going to be underwriting 10,000 properties. And if underwriting a property takes you a day, you need 10,000 days. And that just doesn't compute. Right. So, come up with a system to filter your leads, to focus your attention. That's number one. And once you filtered it and focused it, before you even start your underwriting, look for the 3 red flags, look for the 3 things that are going to knock it out of the park. And that's going to be different every time. So it's not a checklist per se. It's more of, give it a nice once over, a nice glance. Look for when you see, oh, this says expansion potential, is the zoning correct? If you see, oh, the rents are under market, because that's what the offering memorandum might dictate, or that's what the seller might say, call around to the 3 closest competitors. Take the time out to do that initial research that you might have saved for your due diligence period after you've already negotiated and gotten a contract. Save yourself all of that time and headache by looking for those 3 red flags and the 3 things that will knock it out of the park to help you prioritize your time.
Awesome. And so you're going in and you're analyzing deals, you're making sure, like you said, the zoning, the rent, and all these things. So, what does that look like as far as, does everyone in the company look over that deal, or how does, is that mostly your job? I just wondered about how, working together as a team and what that looks like.
Yeah. So it definitely starts with me. And because, we're in a place in the market cycle where capital is a little bit easier than acquisitions. I do look for support within my team to kind of complement
Sure.
the activities I'm doing. But yes, there's a difference between responsibility and accountability. I'm completely accountable for the acquisitions. So I might hand off some of the task responsibility to some of the other folks, but ultimately the entire scope of the acquisitions department, if you will, within our small team is my own. So it does start with me. Once a deal comes across our desk, I'm usually the one that's given it a once over and say, hey, maybe we should be excited about this, or hey, maybe we shouldn't look at this. I do, depending on where it came from, if it came from a personal relationship of somebody else on the team, I do try to say, hey, this is what I'm seeing. It doesn't look like there's really anything here since you know us. Correct me if I'm wrong, and give the source of that information, of that opportunity rather, the chance to show me where I might have misread something. But usually I try to knock it out by myself and not waste anybody's time. At that point, if it passes that kind of second gate, I like to call it. So there's the filtering gate, then there's the first glance gate, and then there's the underwriting gate, where I do a kind of abbreviated underwriting to see what high level would be the estimated returns to us as well as our investors with this particular structure, with our conservative expense assumptions and revenue assumptions. And then once I have that, if it all looks good, after about an hour and a half, I'll look for those 3 red flags if they weren't already kind of able to be seen previously, where I'll look for the rent assumptions to be tested. I'll look for the expense assumptions to be tested. I'll look for the exit or the terminal valuation to be tested. And if all looks good at that point, I do a full pro forma, draft an LOI, put an offering memorandum, put it all into a drive folder, send off a kickoff email, spin up the 2 other folks on the team that say, all right, let's take a look at this. And if all looks good, we've got an LOI out the door within 48 hours. That LOI would usually say we've got 14 days to determine our feasibility. It goes to our business intelligence director, who does a very, very, very thorough and in-depth look at the market analysis, whether or not rents and revenues are correct, if there's an unmet demand for what we're offering, if we can expand, or if we're going to build it and nobody will show up, what the labor market looks like, the job market, population growth, income growth, what the politics look like, what does the mayor have to say about our asset class, all those things. And then after those 14-day period, we're under contract. We started due diligence. We've got a 271 bullet point checklist, not always 100% applicable, but it's all there for us to at least make sure we're considering it. That 271 due diligence checklist precedes us coming up with our offering memorandum and our underwriting that we present to investors. And we say, hey, this is the funding timeline and this is the closing timeline. And because capital, well, one, we've got an incredibly excellent investment officer in our company who has built an amazing set of relationships. But 2, it's also, everyone's looking to place that capital right now. So we say, hey, here's the opportunity. And within 24, 48, 72 hours, we've usually got a multiple of what we need in verbal commitments. And then we move to closing.
Wow. Thank you for explaining that. And it sounds like you all have a great team. And obviously we've had your other team members on the show, and I know they're great performers. And tell us some stuff you all are working on right now.
Yeah. So we have this conversation a lot about what are we working on, and do we want to get folks spun up on it? We have a lot of things that we look at, and it excites a lot of people when we talk about it. And if it ultimately doesn't work out, we're not the only ones disappointed. Our investor base is too. So keeping it high level, we're looking for storage developments, and we're looking to acquire existing storage cash flow that allows us to expand. So that is our target focus. That is our primary focus. That being said, the adventure of real estate brings you down a lot of paths, and we try to not stay distracted. But when somebody puts forward an excellent opportunity that requires creativity and a little bit of elbow grease, we're usually the guys to figure that out. We are the creative elbow grease guys. We are not the private equity institutional money that's going to place the capital looking for a low internal rate of return for the pension fund money or whatever. We're looking for super, super high returns, both to us and our investors, with very thick margins that allow for a market correction to still be profitable, a negative market correction to still be profitable. So when somebody says, hey, here's a 24 cap RV park, we say, okay, we'll take a minute to take a look at it. And I'm not sure if your listeners have heard stories from my partners in the past on the show, but we did in February buy a 24 cap RV park that we have since turned into a 36 cap RV park with the hopes to turn it into a 45 cap RV park by the end of Q1 2019, and then sell it around and turn it around and sell it for over 2.5 times our investment in 2 to 3 years. Just on the valuation, not including cash flows. So we're looking for opportunistic deals, but our target is self-storage or industrial potential for self-storage acquisitions that cash flow and can be expanded on, or land in the Colorado and Washington marketplaces that can be built for self-storage in neighborhoods that have an unmet demand for storage.
Ben, what else is Spartan working on right now?
Well, thanks for asking, Whitney. Spartan has had a lot of folks reach out because of our development core competency. We're good at expanding, and we're good at building ground up. So we've kind of got that skill set to go from having your soil turn into a building that you can sell, and all of the steps in the process along the way. From the strategy to the underwriting to the feasibility to the market reduction to positioning it to be sold to the operations and working with the city and the community to get your development deal pushed through. So a lot of folks have been reaching out, and we realized that we didn't really have a lot of material to share. So we've put together a set of tools that we're sharing with folks. And we've worked with a couple of different folks to help them out. And we're kind of standing up some real estate services to do the underwriting or to do the feasibility or the market reduction on their behalf, or just guide them in the right direction, kind of give them the fishing pole. So that's really what we're excited about, that we can finally answer that question. How can we help you get better at what you're doing, regardless of whether or not it's self-storage? So we're really excited about that.
Awesome. And we can learn more about that on your website, I'm sure, or is that correct?
So I don't believe it's up on the website yet now, but if folks want to reach out, I'm happy to have a conversation with them.
We'll reach out, and we'll have your number and your information in the show notes. Awesome. Well, Ben, why don't you tell our listeners how they can get in touch with you? Yeah.
Email is Ben, BEN, at Spartan-Investors.com. That's Spartan, like the movie 300, -investors, plural.com, Ben at Spartan-Investors.com. And if you want to speak with us about investing, you can check out our site, Spartan-Investors.com, or reach out to my partner, Ryan, at Spartan-Investors.com. And if you want to speak about underwriting or a deal that you have and you want to talk about it, you can email me directly or text me at 973-975-3548.
Awesome. Thank you for being on the show, Ben, and we will talk to you tomorrow.
All right. Awesome. Thanks, Whitney.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.